and will update our GDP forecasts in May. Let me now move to the impact on Singaporeans. As we import nearly all our energy, the spike in global oil and natural gas prices will inevitably raise fuel and electricity costs for Singapore. About 95% of Singapore's electricity is generated from natural gas, whose price is mostly pegged to market prices. The regulated electricity tariff, which most Singaporean households pay, increased by 2.1% to about 27 cents per kilowatt hour for the second quarter of 2026. The increase is modest relative to the spike in fuel prices. But that is because the tariff is based on fuel prices from the first 10 weeks of the preceding quarter, from January to middle of March. That means only a small portion of the recent surge in fuel prices has been captured in this tariff adjustment. Fuel makes up about half of the tariff, so higher fuel prices will flow through to electricity prices. We should therefore expect a much sharper increase in the next tariff adjustment, which will fully reflect the higher cost of fuel. However, the Middle East situation has driven up global energy and commodity prices, which will drive up global inflation. Consequently, we now expect Singapore's overall inflation for 2026 to be higher than earlier projected. If the conflict is protracted, higher inflation in our source markets could also lead to further increases in import prices over time. These pressures will be felt by households in more expensive electricity, transport, and daily necessities. Lower-income households will be more affected as a larger share of their spending goes towards essentials.